Hey investors, are you tired of feeling lost in the stock market? Do you want to stop throwing darts at a board and start making smart, informed decisions about where to put your hard-earned money? We're going to unlock the market's secrets and show you how to find the value of a stock. Welcome to our guide on determining the fair price of a stock, where we'll walk you through 5 key methods to evaluate a stock's intrinsic value. Fasten your seatbelts because we're about to launch into the exciting world of stock valuation. Let's get down to brass tacks, folks. Fundamental analysis is like looking under the hood of a car before you buy it. You wouldn't buy a car without checking the engine, right? We're going to kick things off with earnings per share, or EPS. This tells you how much profit the company is making for every share of stock. Higher is better, folks. Next up, we've got the PE ratio. Think of it as the price you're paying for every dollar of earnings. Lower PE ratios can sometimes mean a stock is undervalued, but remember, every company and industry is different. Now let's talk about the price-to-book ratio, or PB. This compares a company's stock price to its book value, which is essentially its net worth. A low PB means a stock is cheap, but do your homework. It could also mean there are problems lurking beneath the surface. Don't forget about dividend yield. This is the annual dividend payment per share, expressed as a percentage of the stock price. It's like getting paid just for owning the stock. Finally, we've got the debt-to-equity ratio. This tells you how much debt a company is using to finance its assets. High debt can be risky, so keep an eye on this one. Listen up, because this is where things get really interesting. Discounted cash flow, or DCF, is like having a crystal ball for your portfolio. It helps you estimate the value of an investment based on its future cash flows. Sounds complicated? Don't worry, it's not as intimidating as it sounds. First, we need to forecast the company's future cash flows. This involves digging into their financial statements and making some educated guesses about their future performance. Now, because money today is worth more than money tomorrow, we need to discount those future cash flows back to their present value. We do this using a discount rate which reflects the time value of money. Finally, we add up all the discounted cash flows to arrive at the net present value, or NPV, of the investment. If the NPV is positive, it means the investment is expected to generate a return greater than the discount rate. Boom! That's a potential buy signal. In the stock market, it's all about figuring out if a company is a star performer or a bench warmer. That's where relative valuation comes in. We're going to compare our target company with its peers to see if it's overvalued, undervalued, or just right. Think of it like scouting out the competition before a big game. First up, we're going to look at the PE ratios of similar companies in the same industry. If our company has a lower PE, it might be undervalued compared to its peers. But remember, PE is just one piece of the puzzle. Next, we'll examine the price-to-book ratio, or PB. This tells us how much investors are willing to pay for each dollar of the company's assets compared to its competitors. Again, a lower PB could mean the stock is undervalued. Finally, we'll delve into the EV/EBITDA ratio. This metric compares a company's enterprise value to its earnings before interest, taxes, depreciation, and amortization. It's a great way to compare companies with different capital structures. Technical analysis is all about understanding market psychology and identifying trends. It's like being a surfer, reading the waves to catch the perfect ride. We'll start by identifying support and resistance levels. These are price points where the stock has historically had trouble breaking through. Think of them as the floor and ceiling of a room. Next, we'll look at moving averages. These are calculated by averaging a stock's price over a specific period. They help smooth out price fluctuations and identify trends. Now, let's talk about the Relative Strength Index, or RSI. This momentum oscillator measures the magnitude of recent price changes to evaluate overbought or oversold conditions. Finally, we'll examine the Moving Average Convergence Divergence, or MACD. This momentum indicator shows the relationship between two moving averages of prices. By using these technical indicators, we can try to identify buying and selling opportunities. Listen up, because this is where things can get really wild. Market sentiment, or the overall mood of investors, can have a huge impact on stock prices. It's like a roller coaster ride. You never know when the next twist or turn is coming. Economic conditions, such as interest rates, inflation, and GDP growth, can influence investor sentiment. When the economy is strong, investors are bullish, and stock prices tend to rise. But when the economy weakens, investors get spooked, and stock prices can fall. Company-specific news, such as earnings reports, product launches, and mergers and acquisitions, can also move the needle. Positive news can send a stock soaring, while negative news can cause it to plummet. It's crucial to stay informed about the latest news and events that could impact your investments. Congratulations, investors! You've just learned 5 powerful methods for determining the fair price of a stock. Remember, successful investing is a marathon, not a sprint. It takes time, patience, and discipline to master these techniques. Thanks for watching. We hope these methods help you in your stock evaluation journey. Don't forget to like, subscribe, and hit the bell icon for more financial insights. We'll see you next time on Money $3.